All right, good day, Gadfly subscribers. It's CJ, and I'm very excited to be delivering a very special interview with Dr. Jim Willie, whose work you can find at thegoldenjackass.com and also his new site, golden-jackass.com. We have a very special guest for you today. We have Mark O'Brien, who is joining us from Goldcore. So I'm going to go ahead and turn it right over to Jim and let the conversation begin. So, Jim, go for it.
I'm really happy to have Mark O'Brien on from Goldcore. It's I believe, correct me if I'm wrong, it's a gold and silver purchase site and business, but also a secure vault service with global locations for vaulting. Okay, good. I got that right. Just want to make sure. Okay. 10 years ago, a little over, we had the Lehman incident, and it was improperly described. It was more like a scuttle killing of Lehman Brothers by J.P. Morgan and Goldman Sachs. And in the ensuing year or two, we came to know a new acronym, GFC, Global Financial Crisis. I contend that not a single thing has been fixed, that we've gone on for 10 years. We went to a 0% interest rate. We then went to QE, which is hypermonetary inflation of the worst variety, unsterilized. And I contend that we have now entered the new global financial crisis part 2, or redux. And instead of the mortgage bonds being subprime, we've got the U.S. Treasury bond as the global subprime bond. I think we have an event flow, Mark, that is going to turn out to be tremendously damaging. And honestly, I think 3 to 5 times worse than the Lehman incident, the Lehman event, Lehman crash, whatever you want to call it, followed by AIG. What are your thoughts on this blossoming global financial crisis that appears to be part 2 and much bigger? Do you agree that it's going to be much bigger? Do you agree that it's going to be much broader? What are your thoughts on this redux?
Yeah, no, I agree. I couldn't agree more. It's that expression, kick the can down the road, used to be an expression that we all used 7, 8, 9 years ago. We all said they've kicked the can down the road, and we all knew that the chickens were going to go home to roost, and the question was when. And it looks like we're in the early stages of the next financial crisis. And maybe is it part 2, or is it a continuation of the first crisis that we never dealt with? But the bottom line is we are in the early stages of it, and I think it will be worse than the last one, because ultimately all the imbalances in the system that were there before are actually much worse now. There's more debt in the system. They try to call it a credit crisis, subprime crisis, all these different names and acronyms. Ultimately, it was a debt crisis. It was a financial crisis, but it was primarily about debt, and too much debt throughout the financial system, including the banks. And Lehman was just one of the banks that had lots of debt, right. But there was lots of banks that had lots of debt in them. But Lehman was a bit of a fall guy, as you suggest. So, and now the debt is even bigger. So the global debt, if you look at in the aggregate, the global debt back then in 2007, I think it was 250% ratio to the global GDP. So the total value of all the goods and services in the entire world traded between the 7 billion people on this planet in 365 days, it was 250%. So 2.5 times more debt compared to the value of all the GDP in the world. Today, it's gone up to 320%. And this is in a so-called recovery. So it's completely unsustainable. And it's manageable while we have interest rates near 0%, which is happened through, as you said, quantitative easing and through artificially pushing down these interest rates, But it's completely unsustainable. And what's worse is the debt is actually, it's now at every strata of society. Back then, it was more a lot in the banking system on Wall Street, the City of London, in the banks, a lot of mortgage debt, credit card debt, consumer debt, all the rest of it. The sovereigns weren't that indebted back then, whereas now the sovereigns are massively impaired as well, because in effect, the sovereigns bailed out the banks and bailed out the banking system. It wasn't that these central banks bailed out the banks. It's us, the taxpayers. dollars had to bail out the banks in all these countries, and now the debt is very much on the sovereign side as well, and that feeds back into what you said about the U.S. Treasuries. I mean, the U.S. debt is going up $1 trillion a year, 22 trillion. That's just a nominal debt. The actual real debt is, there's different estimates for the unfunded liabilities being 100 trillion and 200 trillion, and the baby boomers are retiring, and you've got the pensions dime, so there's so many of these various risks that are all coming together, and they've managed to not deal with any of them, which means that this crisis is going to be much bigger than the last one. And then the question is, well, how does it manifest,
The big difference that I see now, and I think you agree, is that they've moved from the mortgage bond to the sovereign bond as being the big, overloaded, debt-ridden, poorly underwritten. My gosh, we used to say that the mortgage bonds were badly underwritten. What is the underwriting process for U.S. Treasuries? It's derivative purchase. It's hidden QE. I think it's much, much bigger QE volume than they admit. What do they admit? 30, 40, 50 billion a month? It's more like, I think, $1 trillion or $2 per month if you count all the derivatives. Okay, so now you've got the corporate bonds. They've gone subprime. I've got one client. No, I've got one colleague. We call him Sky Crane. He doesn't like his real name being used. He's Sky Crane. He used to be in the helicopter business. So he actually says, Jim, expect in 2019 and a little bit further that $1 trillion of corporate bonds are going to go to junk. Okay, so before it was subprime mortgage bonds. Now it's sovereign bond and a good slice of the corporate bonds. And I don't know how emerging market bonds and debt, it's not just bond, but debt, not so much securitized. They've got perhaps 8 to 10 trillion more in just emerging market. And now, high yield, you've got to expand the definition of high yield to include a good portion of European and U.S. Corporate bonds. So this is going to be much, much bigger. Okay. I see a lot of changes in the gold market in recent weeks. You can actually make an argument that in every major currency, the yen, the pound, the Swiss, the dollar, the RMB, we have the early signals of a gold price breakout. And you get
particularly
a lot of
Aussie dollars, particularly all-time record highs. Yeah.
It's all the majors. It's hard to call Aussie a major, but it's very close to a major, and it's its own continent, so it's a continental dollar there for Australia. Okay. We've got a mild gold breakout. This is very early stages. I would say if there are 5 stages, we're still in the first, but it's becoming more clear. And I'm excited and encouraged by it. Not tremendously excited, but I look at it and go, wow, that's really nice to see. And if you look at the silver charts, they're very similar. And you get these, downtrend, and we're breaking the downtrend line for the last, say, 5 years of market tops. And it's very encouraging. And you get a lot of information like central bank gold accumulation. Of course, it's mostly the Eastern nations. Okay, you don't hear the Germans, the British, the Canadians, and the Americans are all increasing their gold reserve. No, you don't. We get a lot of bullshit propaganda nonsense out of the West, but if you look at the central banks, they're accumulating, and I think that's a very, very good sign. But this time around, it seems to me the dollar is not going to be regarded as the safe haven. Would you agree that we've got a flip, like a 180-degree flip compared to 10 years ago? Back then, it wasn't very difficult to just march the crowd, march the investment markets, march the bond markets into the dollar. But now you're starting to see a lot of questions about the 22 trillion in debt, a lot of questions about the annual trillion plus with the falsified, gimmicks, pro forma. Okay, what's the deficit this year? Oh, it's 580 billion. Well, then how come the debt went up 1.2? Okay, they're lying about the actual debt, calling, using pro forma one-offs. And okay, would you agree, Mark, that this time around, the dollar and the treasury bonds are not going to be the safe haven?
Yeah, absolutely. No, it's very, very, very clear. At the last time, there was a lot of talk that the euro was going to become the new reserve asset, and that was the threat to the dollar. Obviously, that turned out not to be the case, because the euro had its own issues in terms of just the totally dysfunctional nature of the European Union and all these different economies and one central bank and the monetary union, and it's just it hasn't worked. In large part, it hasn't worked, but ultimately, I think the bigger threat now to the dollar is because of the emergence of these the so-called BRICS, if you want to call them, but the emergence primarily of China, obviously, and China, its currency, the renminbi, is not ready to be the reserve currency of the world, but they're slowly but surely making lots of incremental moves in that direction, and I think that's where it's going ultimately, and they haven't pissed off the entire world like Trump and his predecessor have done, and they're burning bridges with even their allies, and that's not a good way to maintain the currency status. So it's interesting. Even there's an interesting article, I don't know if you've seen it yet, Jim. It came up on the World Gold Council. Some of the research is good, and they had an interview with Ken Rogoff, who's the former chief economist of the IMF, and he's one of the key proponents of a cashless society in the world, and he's at the vanguard of pushing for this cashless society. But he actually came out with something that was extremely positive on gold, basically saying that gold is going to have enormous value in this cashless society. And he made the point, part of the reason is, and he said it's going to be a store of value, it's going to be a hedge. It was something that a gold book would write. It was amazing to hear it from this IMF cashless society mouthpiece. But ultimately it came down to the dollar. The dollar's being vulnerable, moving to this multipolar world. He talked about the U.S. Treasuries. He talked about the $1 trillion deficits. Inflation's going to take off in the U.S. They're not going to be able to increase interest rates because of this huge amount of debt in the world. Right. And there's a quotation there. He says, as the U.S. economy becomes proportionally smaller and the dollarization of the global economy becomes larger, the equilibrium becomes increasingly fragile. So it means the dollar is more fragile in terms of devaluation, and people they're moving to the exits already. They're diversifying into other currencies. They're doing bilateral swaps. They're trading in commodities in their own local currencies. So it's slowly but surely happening. And then it feeds back to your point about the treasuries. He made the point, and again, it's interesting coming from an IMF guy. You expect to hear this from me and you, Jim, and we've been shouting hits and rooftops for years. So this guy, he says what we said. He said, the point is, treasury bills are not a riskless asset. Yeah, no shit. I'll just finish by saying they may be for 2 or 3 years, but not necessarily for the long term. So if you want to build a 40-year plan, you should have some diversification. Right there, So, but it's interesting. So 3 or 4 years, you're saying they may be, but medium term, even 5-6 years, you're saying they're not a riskless asset, and that's revolutionary in terms of portfolio building and managing assets. And the high net worth people and the hedge funds are going to listen to this guy. He speaks at Davos, and they're hearing that, and they're going to start reducing their allocations to treasuries in a big way.
Well, isn't it amazing that we've yet to hear any commentary from these, Keynesian and established voices?
Nabobs.
That we have not yet heard. There might be a treasury bond formal default, restructure. I'm expecting a restructure. I think it's already been going on. Okay, you hit on exactly where I was going to go. You mentioned Rogoff. I was going to mention Druckenmiller and Sam Zell. Sam Zell is a property magnate.
Billionaire, yeah.
Yeah, they're both saying that gold should be in your portfolio. And what they're really saying is that gold is now a safe haven asset and should be part of your structure, part of your plan. I don't pay any attention when they say, well, you should have 2% in gold. No, I think you should have more like about 40% in gold and the rest in silver and nothing in paper. Okay, but we're starting to see a transition, a shift in the elite opinions. Okay, you mentioned Rogoff, but Druckenmiller and Zell, there are more. There's several more, and they're coming out. And this is revolutionary. This has never been seen before. Yeah. And, okay, in these last few years, we've seen big structural changes where the dollar is not going to be quite the safe haven it was before. I think it's going to be shunned. I think it's going to be spurned. I think it's going to be harshly criticized. I think the United States is going to be accused of running third world finances for the dollar. But take a look at just some of the major platforms, the Belt and Road, the initiative led by China. I mean, what is it now? $5 trillion, $6 trillion of commitments, but none of it is going to be resulting in dollar trade. Then you have the Shanghai Petro RMB contract. Okay, that links oil, gold, and the RMB all together. The Russians are all over that, converting RMB payments into gold in Shanghai using Sberbank. It has an office in Beijing. So it's not just the elites who are touting gold. It's the whole system is moving toward what I call a dual universe. You cannot ditch the dollar and go straight to gold. I think you need a caretaker. And I think that caretaker is the Chinese RMB currency, which I believe is going to be interchangeable with gold via the gold trade note. Okay, I've been told, it's kind of private conversations. It's the voice and it's more. We're going to be seeing the gold trade note, and that could be the transition device for, it's hard to describe, for a gold convertible RMB, but also for movement away from the Treasury bill on oil payments and on container vessel payments and on agricultural payments and on, say, consulting payments, probably last. These are exciting times, Mark. I see, while I do see a big change in the last 10 years away from the dollar as safe haven, unfortunately, I see a great deal of damage economically and to household wealth. I don't want to get into individual stories, but I just hear more and more pain, lost jobs, businesses down. Obamacare hurt my small business. There's a lot more damage right now than there was in 07 and 08. Economic damage. And you can also say that we've got society damage. Look at the Yellow Vest movement in Europe, but look at all the nonsensical movements in the United States of Black Lives Matter and Antifa, the anti-fascist. It's amazing. The Antifa anti-fascist is fascist. Okay, so everything is backwards. Anyway, I agree with you, and I'm glad that you agree with me that the dollar just doesn't have its luster in this redux of the global financial crisis. Okay, why don't you tell me what you believe as the important aspects of having gold and silver in your investment portfolio? I think we're going to have a big movement out of paper assets. I've got some colleagues who go so far as to say that you could see over a 50% decline in many stocks and bonds of the U.S. dollar variety. And I don't know about that. I think that's a bit dire, but what are your beliefs on the future of paper assets and the importance of precious metals in your portfolio?
I mean, yeah, bottom line is on the dollar and the fiat currencies, they're all going to lose value in quite a big way in the coming months and years, and they're going to be sharply devalued. In terms of stocks and bonds, it's very tricky to know because the scale of the quantitative easing is so much that, potentially, and also the manipulation that goes on in terms of the plunge protection team, the PPT, the working group in financial markets. These algos are very, very powerful indeed, and I think they're in there buying up the S&P 500 futures every half hour and on the close and on the open, and there's a lot of manipulation going on. So I try and stay agnostic on the stock market. If you get a massive deflationary type of thing, then obviously we could see 50% falls as we saw in 2000, 2008. Same time, if they're very, very determined, they want these stock markets to go up because they know it's a huge indicator, it's a huge confidence driver, then who knows, potentially, they might get it higher. And plus, as they print enough dollars, they can get it higher. And, you look at Venezuela and Zimbabwe, their stock markets have done very well indeed, So if they do go up, I think they'll be in a quite, highly, highly speculative and highly risk. They're not long-term investments, let's put it that way. And I don't think you have any business, fine for a speculator, but not really for anybody who's, you're talking about investors and people in the portfolio. And similarly with bonds, I think bonds, potentially there's more risks in bonds, particularly in the government debt market, given the scale of the debts, and they're totally artificially propped up through this quantitative easing last few years. So I think bonds are potentially more vulnerable than stocks in some ways. So the bottom line is your traditional portfolio of a balanced portfolio of 40%, 50% equities and bonds and a small amount in cash is just crazy in this day and age. It's not balanced in any way. It's totally unbalanced and totally, you're totally risky. So because especially what we just talked about there and the risk with treasuries, which are meant to be the riskless asset, they're meant to be the benchmark asset, your US treasuries, So it does mean that you should have higher allocations to gold, to silver, maybe a little bit of platinum, a little bit of palladium, cash, having some cash outside the system, I think is a good idea as well. The high value notes, not too high value because potentially they might cancel them out like they did in India. And that's if Rogoff has his way. In this interview, he talks about, we're not going to go totally cashless. We'll allow the little people have their $5 notes and their $10 notes, but they're going to cancel the big notes. The €50 and the $50 could be vulnerable, which is crazy stuff. And I mean, my belief is that they should be encouraging us to have money outside the system because it makes the consumers and the citizens just much more not fragile, and much more robust. And if they really want economic growth in the medium and long term, they need people who have healthy finances, And but if you destroy the system, you have all their money corralled into this digital system, and then the digital system goes down, as we know, will at some stage, whether it's through a collapse of the banking system or through Wi-Fi issues or cyber wars or cyber terrorism or EMPs taking down the electrical grid, whereby electricity is out. I had an email from a wholesaler, a big wholesale bullion merchant the other day saying how their electricity was out because of the snow in north of America, and their electricity is out and they had issues with their phones. And, and this is just a bit of snow for a few days. Can you imagine you get a real systemic crisis of what that will do? So, I mean, that speaks to, as you said, much higher allocations. I mean, the standard rule of thumb is that we've always said put 10% of your wealth into physical gold. The old adage is you put 10% of your money in gold and you hope to God it doesn't work. Because if it does work, it means the other 9% of your assets have gone down. But in this day and age, given the degree of risks to the bonds and the stock markets, you can justify much higher allocations. And I would never advise people. I advise you should have higher allocations. But that's what I do. Personally, I would have obviously the business here, and I would have higher allocation of precious metals because I do believe that they're massively going to outperform. And you need much more insurance in the uncertain world that we live in today, And for all the reasons you mentioned, that political uncertainty is it's all over the world, The yellow vests is, and we're going to get some authoritarian governments at some stage, whether it be left wing or right wing, and that's when you need to have some of your wealth outside the system,
When you mentioned bonds not being so favorable, I couldn't agree more. When we see corporate bonds lose, and they're likely to see significant haircuts, it seems like the word haircut is used for bonds more than any other asset. A big haircut for the bondholders. Okay, the cocoa bonds, they have giant hits. That's by design. When we see a lot of different bonds take hits, I think it's a sign that we're going to start to see some extreme damage, not just to the reputation, but to the value of U.S. Treasuries. It is the global subprime bond. I just am so convinced that we're not going to have a safe haven in the dollar. We're not going to have a big Treasury bond run. We're not going to have a move down to 1.5% on the 10-year Treasury bond. It's just not going to happen this time. They cannot just let this inflation run without a reaction. This inflation is going to become a bigger story, and I think it's going to be a big push for gold and silver. Not just the lack of integrity of the dollar, not just the absent safe haven of the Treasury bond. It's going to be inflation and what's out there that can serve as a safe haven, and it's going to be seen as gold and silver. I'm absolutely convinced, and a lot of Americans are going to be taken off guard. A lot of Europeans are going to be taken off guard. Let's move to your gold core business. I want the whole second half to be about your gold core business. Why don't I let you describe it? I don't want to do it an injustice, but it's for purchase of precious metals, and it's for secure vault services for those precious metals. So why don't you take the ball and run and I might interrupt with a quick question for clarification, but
yeah, please do.
Go ahead and run with it. You got two sides, right, Mark?
Yeah, I mean, we do ensure delivery throughout the world, but mostly the Western nations and English-speaking nations, and nations that have decent customs authorities and delivery mechanisms whereby we can use UPS and FedEx and Royal Mail, and we can deliver to clients. So we have clients in over 140 countries, over 16,000 clients. We do the delivery, but it's probably 10%, 20% what we do. What we specialize in is actually on the storage side. So secure storage, Gold Core secure storage is very much a big focus of ours, because since we were founded in 2003, and we've long taken the view that gold is a safe haven asset. There's no doubt about that. From even though some of the crazies and the Keynesians and the uber Keynesians, I mean, Keynes would turn in his grave, as you saw what they said, but even sometimes they try to make it it's not a safe haven asset, but all the research is there, all the data is there, history is there. There's independent asset allocation experts have shown it, the academics have shown it. It's there. It goes up when everyone else goes down. It's exactly what you want in the portfolio as a hedge and safe haven asset. So, but it's only a safe haven asset if you own it in a very safe way. So we said, right, how do we allow people to own gold in the safest way possible? And we started looking at the safest vaults around the world in the safest jurisdictions. Initially, we were working with the Perth Mint in Western Australia because we felt that was very safe. It was AAA rated. Obviously, then financial crisis 2008, 2009, governments started bailing out banks. The sovereigns became much more vulnerable. So we sort of reevaluated our affinity with the certificate program. We still offer it. It's not a bad way to do it, but we don't think it should be seen. It's more for investors with pensions who aren't concerned about systemic or geopolitical risks, So the primary focus is very much, Gold Core secure storage, which is, we believe it's absolutely vital that people own gold allocated and segregated. There's a lot of unallocated, there's lots of so-called allocated, which is actually pool allocated, whereby you are a part owner of a large bar, and in effect you're an unsecured creditor of the platform or of the provider. So we do is actual, I said, allocated, segregated. People have individual legal title to their own coins and bars. We're merely the custodian. They have outright legal ownership of their coins and bars in the vaults. And basically we work with Brinks in Singapore, and we work with Loomis in Hong Kong, in London. Zurich would remain the most favored location internationally, and it remains. When I'm asked by my clients, where do you think is the safest place to store bullion, I continue to believe and recommend Zurich. And then more recently, we offered storage here in Dublin in Ireland, because there's demand obviously from Irish clients who want to have it closer to home. But interesting enough, there were some UK clients as well who said, listen, I'm not sure about the UK, I'm not sure about sterling. I think not so much worried about Brexit, they're actually more worried about the political ramifications, what you talk about there, the rise of yellow vests, the rise of left-wing, right-wing, polarization of society, civil war-style politics. Jeremy Corbyn is very left-wing indeed, and they're concerned that there may be wealth confiscation and increase in capital gains tax and all the rest. So they said, right, I'd like Dublin as a one-hour flight from London. I'm going to have some of my gold outside the UK in case there were capital controls, exchange controls, all the rest, So the bottom line is, we don't say, listen, put all your eggs into any one of these jurisdictions. We always say, listen, have two or three. If you feel safe enough in your own home, take delivery. That's automatically, if you feel safe in your home, you should take delivery of some gold and silver bullion. Be very discreet about it. Don't tell anybody. Don't tell your neighbors. Maybe don't even tell your loved ones. Maybe give a note to a solicitor saying it's there. Make sure somebody that you trust knows it's there, and that your loved ones will have the benefit from it if God forbid ever happened to you.
And don't ever tell your mistress.
No, definitely not.
Could you give me an idea? How much of an increase have you seen from British clients in just the last 2 years?
In demand for gold, specifically from UK clients?
Yes, not just demand, but vaulting services, moving away from the British jurisdiction, moving away from risk, from Brexit risk, from yellow vest threats. Just have you noticed like a big jump up, like double, triple?
No, we haven't. I mean, I see some of our competitors seem to put out press releases and they say, no, the phones are ringing off the hook and they're run off their feet and there's a gold rush going on, and there's a lot of hyperbole. It's, considering the degree of risks, it should be a lot more, but it hasn't happened as of yet. There is an increase in demand, and it's consistent and steady. And, I'd say year on year, don't have the exact figures to hand, but I'd say the last 2 years, the UK demand is probably up 20-25%. It's brought in line with the demand that we're seeing in terms of the wider company, the Irish clients, UK clients. We have quite a lot of American, Canadian clients as well. So our overall demand is up sort of 20-25%, and that the big metric metric for us is actually the ounces, because obviously the dollar amount can go up, the euro amount, the sterling amount, they can all fluctuate, but we always focus on the gold ounces. That's the metric for us, and those ounces are up another, I think, 24% this year, you know. So yeah, the sterling one is interesting because we have an interesting, it's not a niche per se, but I suppose a USP, a unique selling point, but it's hugely advantageous to the UK clients because they can buy a capital gains tax-free gold from us in the gold sovereigns and the gold Britannias because they're a legal tender coin of the realm. So it's an absolute no-brainer. If you're a UK client, why would you buy gold money or bullion vault or a gold ETF when you have this massive CGT liability, which will likely go up in the coming years given the scale of debt in the UK, you know? So that's an interesting angle. They like storing gold with us in Zurich, in Dublin, sometimes in London because they want to have it closer to home as well, you know. And they can. The thing with us, it's held in bailment. So again, they have outright legal ownership of the gold. They can go visit most of the vaults. They can actually go and visit and inspect their gold. You can't do that in Dublin because the security requirements are even higher in Dublin because of our experience of criminals in the past. But you can go visit, you can inspect, and you can take delivery, or you can pick up the phone and you can ask us to move the gold to other jurisdictions or indeed to other bullion dealers, you know. And that to us is very important because that way you ensure both your ownership, but also your liquidity and your pricing. And pricing isn't something that people talk about frequently, and it's an important consideration, which we might get into.
Yeah, could you give us an idea on premiums, or if you're permitted, and also the choice? Like if I have a client who comes to you and says, I want to buy $120,000 worth of bars, and I want to have this percentage in gold and the rest in silver. Do you have what are the denominations? What are the sizes of bars? Is it all coins or is it coins and bars?
Well, we do coins and bars, yeah.
What are the size of the bars?
Well, for someone doing 100,000, we would generally, it sort of depends on, you know, there's a few things in terms of where they live, where they think they're going to be living. They think they're going to be living there for all time. Are they going to store it in their house? Do they see it as sort of half investment, half insurance? Are they totally insurance minded? They think the system's going to collapse, and so if they're very, very bearish and they think the system's going to collapse, then we would recommend more coins generally because they tend to be more liquid. If you're an American investor, we would tend to recommend the US Eagles, or maybe Canadian Maple Leafs. If you're a British investor, we would tend to recommend the UK coins because, you know, they're more well known and more liquid in these worst case scenarios. If you're an investor, you know, and you're not so concerned about those risks, then you might move up to the kilo bars, because obviously you buy them cheaper, and that's what comes into the premium thing, because the kilo bars might be, say, 2% premium in volume, whereas if you're buying a 1 ounce coin or bar, the premium might be 4%, 5%, you know, depending on the volume you're doing, you know. So, you know, if you're really worried about a systemic crisis and a collapse of the banks, and I don't know if you saw it this week, Wells Fargo, it's funny, I see these stories, and then I never see the outcome or the denouement or the conclusion. But Wells Fargo this week, their ATMs went down, their online banking was down for a long period of time. Nobody knows what happened. They haven't told us what happened. Were they hacked? What was the issue? We still don't know. But that right there is a reason why you own some gold and silver outside the financial system, you know.
Let me pitch in. We got a few extra minutes here. It's a big story, Wells Fargo. To begin with, it's considered a Wall Street bank, although it's located in California. However, it has a distinction. It is the biggest Chinese investment bank. That's where they put their treasuries, and that's where they borrow 10-to-1 to buy U.S. urban commercial property. Okay, that's just background. In other words, if there's a trade war going on with China, you want to attack, if you're the U.S., you want to attack Wells Fargo. But there's more to it than that. I'm the beneficiary of some very hot analysis from 2 or 3 colleagues who are just knee-deep in the day-to-day, in the behind-the-scenes. And what I've come to learn, Mark, is that Wells Fargo had a gigantic loss. Gigantic. You know, like an order of magnitude bigger than ever before. And it's on its investment side, and it's along its credit portfolio side. It's everywhere. And we as a group came to a kind of a not a solid conclusion, but kind of a consensus loose conclusion that Wells Fargo might be in danger of financial failure. So It was
just recently, or
yes. And it might have been taken over without the announcement that it was taken over. It might have failed. It might have had significant overnight failures, might have had significant asset requirement failures, and it could be that the U.S. Department of Treasury under Trump took it over with a side view of the fact that it is the primary Chinese bank in our large bank system, in our systemically important financial institution, the SIFIs. Okay, so I'm trying to dig up information to verify that we might have seen a financial failure along the lines of Lehman. And you can't say, well, it's their energy portfolio, or it's their commercial property portfolio, or it's their,
it's their IT manager in Wisconsin.
Yeah, or just, investment banking that went sour. Here's what I think it is. If we're going to call this current financial crisis, the Lehman Redux, then I'd like to call the financial problems from Wells Fargo to be the everything bond bubble problem. It could be everything that went wrong, not one thing, everything. Could you describe?
Deutsche Bank is another one that you've looked at before.
Yeah.
And you look at that share price right there. There's an accident waiting to happen.
Let me just share with you some things there. You probably are aware. You're closer to it than I am in being in Europe. But there's a lot of talk that there is a
share
merger.
price in front of me here. It's not a pretty sight.
A merger might be in the works with Deutsche Bank and the big French banks. I've heard Societe Generale. I've heard also BNP Paribas. And I'm beginning to think, well, it could be all three. The French banks have almost 4 times the Italian debt exposure compared to German banks. So if Italy is going down, there's probably going to be a merger with some big financial institution in Europe that's going to guide the way and prevent a systemic collapse. But okay, before we go, could you mention, you said 140 countries for your clients and 16,000 clients in all. Could you give us a better idea of your vaulting location options? Because I was surprised when you described them all. I thought you had 2 or 3, but you have a lot more than that.
We do, yeah, and we're working on more because there's a movement. It's like the central banks. The possession is 9/10 of the law, and there's that global repatriation movement. And if it makes sense for the central banks to own gold and to repatriate it into home country, then it makes sense for individuals as well. We all need to become our own central banker. So there is a movement for people to own gold in country. So sorry, we actually store in Delaware. We've stored in Delaware since probably 2007, 2008, but it's not particularly popular. But I do think for some Americans who don't want to have a huge amount in their house, it does make sense to have some in the States, or potentially just over the border in Canada, So yeah, we store Brinks in Singapore. It's been very, very popular. Obviously, Singapore is quite good in terms of liquidity. It's become a precious metals hub. Very strong sovereign there, creditor nation. We store in Hong Kong as well. Initially, Hong Kong took off quite significantly and did very well, but less popular of late. I think there's nervousness around China potentially, and China has its own economic issues, and I think that creates slight jitters about Hong Kong. But I think Hong Kong will be safe in the long term, but I don't think the Chinese are going to be confiscating gold anytime soon. But most popular is Zurich, and then we have Dublin and London. So so Zurich remains the most popular, and basically it's allocated, it's segregated. Each client has individual outright ownership of their coins and bars. We have a tripartite thing as well, whereby we'll give the client their asset statement. They can log on to our portal and see exactly what assets they have down on a granular level in terms of individual coins and bars, how many bars they have, the serial numbers of the bars, and then they can actually go on to the Loomis website or go onto the Brinks website, and we give them a login with their own special code and their special password that they can log in, and then they can independently corroborate that they outright own those assets that we've told them they've owned, because there have been cases of bullion dealers selling gold and the clients don't actually own the underlying assets, you know. So it's a great way. It keeps us all honest, and they have that transparency. But one of the most important things is that portability. This is the great advantage of gold, that you can move it anywhere you want, take delivery of it, move it to another bullion dealer. If you're not happy with us, our storage charges, just to tell you, they're 1% per annum from 10,000 to 100,000, and then there's a sliding scale thereafter. It comes down to 50 basis points if you're over, I think it's 250,000, 300,000. It comes down to 50 basis points. So it's all there on the services page of the website. That's the primary page about our storage services, and you know, people are more than willing to pay it. They think it's cheap because they realize the degree of safety and security we've built into it is unparalleled in the industry, you know, and people say, well, it's well worth it for the service they get, you know. So it's, yeah, as I said, 1% per annum for 10,000 to 100,000, and with that, it's allocated, it's segregated. You can take delivery, you can move it, and it keeps that movability and portability. It keeps us honest, because with the digital gold providers and indeed the ETFs, the spreads could be blowed out on their pricing at any stage. Whereas if you own 100 crew grams with us, if you get on the phone to us and say, I want to sell those 100 crew grams, and we say to you, okay, well, we're going to give you 5% below spot, you would say, are you kidding me, Mark? Good luck. I'm moving my 100 crew grams to XYZ provider and I'll sell to them. So you have that liquidity and you have the competitive pricing. Whereas if you own gold with a digital gold provider, you know, xyz.com, gold.com, and you go to sell your gold with them, they could be taken over, or they could have aggressive management who decide, well, let's increase our spreads, and you can only, when you go to sell with them, you can only do it online. You can't do it on the phone, and you can only sell at 5 or 10% below spot, and you are a price taker. You're absolutely dependent on the price they give you. The beauty of owning crew grounds or 1-ounce bars, allocated, segregated, is you can sell them anywhere you want, whenever you want, to another dealer, or indeed, and also with some of those other dealers, there's hidden charges when you do go to take delivery. They have hidden charges and all the rest, you know, some as high as 2%. So it's a very, very important consideration, and a lot of people don't give that any thought. That, you know, they're always thinking about the buy and how to buy, but they don't think about the exit, and you have to think about these exits, you know, particularly in worst case scenarios, you know.
Right. Do you want to mention one or two of your primary competitors and how you're like head and shoulders superior, or would you rather leave that alone? And in private conversations, you mentioned a certain group on Jersey Isle. Do you want to say anything? Because I think you're better focused than some of the competitors. You don't have the sideline businesses. You don't have, like, you know, the debit cards and all the EU requirements that have screwed over a lot of U.S.-based people. You want to mention some of the individual?
I don't want to, you know, mention competitors by names, but you know, but yeah, I think there is a lot of distraction from core business with some of these other businesses, and I think they've lost sight of their
distraction, you know, from their core business.
Yeah, right. Yeah, and their mission statement, which is ultimately to protect their clients' wealth. You know, I think there has been distraction, and I think we have remained true to, from day one, our mission statement was to protect and grow our clients' wealth, and I think we've done that very well over the last 15 to 16 years. You know, and we'll continue to do so because we are very aware of these worst case scenarios, and we plan on that basis. You know.
Yeah. Okay. As a closing item, this is kind of a favorite topic of mine. I get a lot of clients who say to me, not just when. I hate the question when. I like the question, how will it look when the changes come? Like for instance, when the COMEX has lawsuits and shuts down, when the LBMA is revealed as a fraudulent center and its exchange for physical is identified as just unbelievably fraudulent, so that the COMEX and LBA are fraud-ridden on the buy side and the sell side, the deliver side, every side. Okay, I have an opinion that we're going to have a period of time, and I'm curious if you tend to agree, or, you know, what your thoughts are. We're going to have a period of time where it's going to be difficult to say what the gold price is, difficult to say what the silver price is. And what will emerge from a lot of dust and fog will be a price in London, a price in Dublin, a price in Hong Kong, price in Singapore, a price in Shanghai, a price in Dubai, a price
A
in
physical price. Yeah. A physical price with different premiums. Yeah.
Yes. So like 7 to 10 locations around the world, and each one will post a price, and someone will say, it makes a lot of sense to take the average of these, just say 10. And that will be your new gold fix. It won't be a corrupt cigar-filled room with insider trading and a lot of corruption from 2 hours before they announce by the insiders profiting. It'll be like 10 different, and there might be say a 1% or 2% deviation among the 10 from the highest and lowest. I don't mean like standard deviation in a statistical sense, but the range might be at like a percent or two. Do you think that's very likely as what will come when the dust clears after we get the inevitable crisis of corruption in the gold market? This is going to blow up.
Yeah.
I don't know how, and I don't know when, but it's going to blow up. They're pushing it in every possible way to the limit. And when I saw the London Exchange for Physical, I said, okay, start the clock. This is it. You got annual gold mine output being delivered that's far beyond 8 times larger than the LBMA vaults for gold. Okay, could you give us an idea of what you expect? Because I shared what I expect. What do you expect the gold market to look like after the dust clears?
I think it's interesting. I think you're onto something there, and that seems quite likely. Actually, not possible. I think it's quite likely. There's a long way to get there, and obviously it's going to be very messy along the way. In terms of the COMEX default, and then the LBMA is not default per se, but people are just going to move away from the Ponzi. That is that whole unallocated.
We might have suits instead of default.
Yeah, exactly. And who knows, it may mean that the digital gold price that we trade today, the spot gold price, might actually go down in the short term, in which case the physical market, you start focusing more on the actual premium, and you might have, if the gold price went from up to say $5,000, euros, pounds, and then there was a massive sell-off down to 4,000, but the premium might be 20-30%. On the physical product rather than 1-2%, and then it feeds into the point you're saying, the markets that have deep pools of liquidity, such as Zurich, not so much London, because I don't think there is much physical gold in London, but Zurich obviously would probably have one of the lowest premiums for physical gold, on a kilo bar format, which would probably be the Asian bar of choice, the Chinese bar of choice, and indeed the institutional bar of choice will most probably be the kilo bar, Right. So that would probably become the benchmark pricing would be off that kilo bar, and then you would have premiums in different loco London, loco Zurich, loco Mumbai, loco Shanghai. Shanghai will probably be fairly competitive, I would think, because I think they're going to move to have their own, and they are moving there slowly but surely as well. Obviously, Singapore is there as well. So who knows? And hopefully, sorry, go on. Frankfurt, I think the Germans will be smart enough to.
Yes.
Yeah,
We're likely to see both a gold price posted and a premium price. Premium value posted, and the premium, as you say, would be a great indicator of supply. All right, I know you've got something at the top of the hour. Do you want to make a couple of closing comments, a final pitch for Goldcore? We're going to have your banner up on this, and this is going to be shown as a public service, public domain interview. And this is the first one we've done, Mark. We debated over this, and I got permission from my Gadfly partners. I said, this is too important. We can't just have it for our paid client. This is a public service, public domain item. So why don't you make a final pitch? And
you're very good, very, very kind, and thank you, Carlos, and thank you, your Gadfly partners. I appreciate it, and thank you, Jim. It's been great working with you over the years. I mean, I don't like pitching. It's not in my nature, but I do fundamentally believe everybody should own gold and silver coins and bars in the safest way possible. We do that. You did ask me about the competitors. I don't want to bash competitors, and I'm not going to do it, but we have had experience of clients who, when they've gone to take their gold out and take delivery, it's been made very, very hard for them indeed, and there's been extra charges and delays, and people not replying to emails, and people not replying to phone calls, and taking weeks and weeks, and actually being quite obstructive, and that's not the way any business should operate, and that should create concerns. So I would encourage people to test it. If you maybe you have a great relationship with the XYZ company and your experience has been good, but see how quickly you can take delivery your gold and silver, and if there's any delays, then that should raise flags. And don't have any of your eggs in any one basket. Even Goldcore, I tell people, listen, don't have all your eggs in the Goldcore basket. We're not some superhuman superhero company that has no risk. There's risk to our company as well, but we're very aware of these risks, and we've put in a lot of protections, and we're very good at managing these risks. So, but at the same time, you should have a relationship with a second bullion dealer, and maybe having one in Europe and having one in the US, or, in different continents or different time zones, it makes sense as well, So it's all about diversification, and that's very much what we help people. One other thing we do is, you asked me about a client who has 120,000. We do provide quite a bespoke service, because a lot of people, they have so many questions, they don't know what to do. So we've got a great team in here. When people call us up, we'll actually say, right, what are your goals? What are your ambitions? Are you retired? Do you have kids? Where are you living? Are you going to live there for the rest of your life? Do you have a second residence? Where are you going to be in 10, 20 years? Where do you want to be if the shit really hits the fan, And we'll really get down into, well, okay, if this is what they want, therefore kilo bars are not appropriate for this person. This person should be buying silver eagles and gold eagles, or they should be buying whatever it is. We do really try and add value in a big way, and we don't charge for that. It's built into the premiums and into the storage rates as well. So yeah, give us a call, and I think you'll find that you get a very, very good service indeed.
Okay, well, good. That was a fine pitch. I noticed you didn't mention your own name too much. You're kind of modest. It's Goldcore.
Goldcore.com. So goldcore.com, you'll find us on all the usual channels. We have quite a big social media following on Twitter and Facebook and YouTube, all the usual place. And you can sign up for our market updates on goldcore.com, where we feature Jim quite a bit. So you can sign up for the YouTube videos as well. We do a weekly video as well. And and you'll find us on all those usual channels,
Well, I've got your banner on my website, old site and new site with the hyphen. We just had a changeover on the Golden Jackass. It's now www.golden-jackass.com, and we got a banner on both. It's very prominent. And now
appreciate that, Jim.
Your main offices are Dublin and London. Is there another main office, or just those two?
No, we have a US phone number as well for US clients. But the phone calls get routed into the Dublin office here. Okay. Yeah, and that's okay. Here's the head office.
I recommend people to take a large slice out of their paper assets and put it into Goldcore precious metals with secure vault service. People are going to get shocked, Mark. They're going to get shocked at not just how much stocks and bonds can go down in value, but how much less they're going to have for purchase value. We're likely to see maybe a conserved conserved dollar-based assets, but we're not going to see a conserved pricing power. We're going to see price inflation, I think, take off.
It's only a matter of time, as you said. Yeah, it's only a matter of time, and I think it's sooner rather than later. I mean, a lot of us so-called gold bugs. I don't really like the term because it's generally using a pejorative term. But
I'm not a bug. I'm not a bug. I'm not an insect.
Yeah, exactly.
My stuff is a pillar.
Gold butterflies. Yeah.
A gold pillar. A pillar. Pillar.
Gold pillars of society. Yeah, I mean, ultimately, we've been wrong. Sorry, it's not been wrong because very few of us have said this is going to happen tomorrow, but we've all said there's a real risk in the medium term, and it's coming, and it's going to be sooner rather than later. Is our sense of it.
I look at the time between significant events and the magnitude of those events. It's accelerating in time and it's accelerating in volume. Okay, all right. Well, we've run out of time. You've got something at the top of the hour. I promise to terminate by then. And thank you immensely for being on, Mark. And I encourage people to go to Goldcore and look at the banner on my website, goldenjackass.com. And these are exciting times. I just wish they weren't so darn dangerous. These are not friendly times.
No, exactly. No, it's not going to be pretty. But we came through the last crisis. The next one, as you said, is going to be worse. But I think half the battle is just having these conversations, being aware of it, being psychologically prepared as much as materially prepared, you know. And then when these things happen, you say, well, you know, we knew it was coming, and you know, and you're prepared, you know. It's half the battle.
Yeah. Well, I've got lots of water and lots of tuna and lots of frijoles. It's black beans.
Yep.
I love black beans. I love
We'll
black.
head down to you for some nachos.
Yep. Jim, Mark, I want to thank you both for a wonderful, very informative discussion. Again, golden-jackass.com. Also check out Mark's work at the at goldcore.com. And then also he has a Twitter handle, and then also go at goldcore for Twitter. So thank you both very much.
Thank you, Carlos, and thank you, Gadfly, and thank you, Jim. Absolute pleasure.
It's a pleasure.